In 2008, the global financial system began to collapse. Banks stopped trusting each other. Credit markets froze. Stock markets crashed. Housing prices imploded. Panic spread faster than any virus. For a brief moment, the entire modern economy stood on the edge of failure. Governments could not act fast enough. Politicians argued. Markets fell. Confidence evaporated. And then something extraordinary happened. Central banks created trillions of dollars, not by printing paper, not by digging gold, not by raising taxes. They created money digitally with keystrokes. In weeks, balance sheets expanded beyond anything seen in modern history. This policy had a name: quantitative easing. Most people heard the term. Few understood what it meant. Even fewer understood its consequences. Officially, quantitative easing was designed to stabilize the economy, to provide liquidity, to lower interest rates, to prevent depression. But in practice, it did something much larger. It rewrote the rules of money. Before 2008, central banks influenced markets indirectly. They adjusted short-term interest rates. They signaled expectations. They responded cautiously. After 2008, they became active participants. They bought government bonds. They bought mortgage securities. They supported financial markets directly. They expanded their own balance sheets massively. The Federal Reserve went from under $1 trillion in assets to over $4 trillion in a few years. Then, even higher in 2020, the European Central Bank followed. The Bank of Japan followed. The Bank of England followed. The world entered an era where crisis automatically triggered money creation. This was not traditional stimulus. It was structural intervention, and it changed everything. Most people imagine money printing as trucks delivering cash. That is not how quantitative easing works. It is far more subtle and far more powerful. First, understand this. Central banks do not print money for citizens. They create reserves for banks. Here is the basic structure. Step 1. The central bank decides to buy assets, usually government bonds, sometimes mortgage-backed securities, occasionally corporate bonds. Step 2. The central bank purchases those assets from financial institutions, not from the public, not from small businesses, from large banks, investment funds, and major financial intermediaries. Step 3. Payment does not come in paper currency. The central bank credits the reserve accounts of those banks with digital money, newly created out of nothing. On the central bank balance sheet, assets increase. On the banking system balance sheet, reserves increase. No taxpayer funding. No immediate inflation in consumer prices. Just electronic expansion. Now here is the key. When banks receive reserves, they have more liquidity. When yields on bonds fall, investors look elsewhere. They move into stocks. They move into real estate. They move into private equity. They move into riskier assets. Quantitative easing does not directly hand money to households. It lowers yields. It raises asset prices. It pushes capital outward. This is known as the portfolio rebalancing effect. If safe assets yield almost nothing, investors seek higher returns elsewhere. And when trillions enter the system, asset prices respond. After 2008, stock markets recovered rapidly. Housing markets stabilized. Corporate borrowing became cheap. Wealth holders saw portfolio values surge. At the same time, wage growth remained modest. Productivity gains were uneven. Many households struggled. The recovery looked strong on paper, but uneven in experience. This is not accidental. Quantitative easing transmits through financial channels first, and financial channels are owned by asset holders. Now consider interest rates. When central banks buy bonds, bond prices rise. When bond prices rise, yields fall. Lower yields mean cheaper borrowing. Governments can issue debt cheaply. Corporations can refinance. Homeowners can refinance mortgages. This supports economic activity. But it also encourages more debt. When money is cheap, borrowing expands. When borrowing expands, leverage increases. When leverage increases, the system becomes more sensitive. This creates a feedback loop. Markets expect central bank support. Investors price assets, assuming intervention. Risk-taking increases because downside appears limited. This phenomenon is sometimes called the central bank put. If markets fall sharply, intervention is expected. And this expectation shapes behavior. Over time, quantitative easing became normalized. In 2008, it was emergency policy. By 2012, it was standard practice. By 2020, it was immediate response. During the pandemic, central banks expanded balance sheets faster than ever before. Trillions were created within months. Liquidity flooded markets. Asset prices soared. Technology stocks reached record valuations. Real estate prices climbed. Cryptocurrencies surged. Speculative assets multiplied. The system did not collapse. It inflated. And that inflation did not immediately show up in consumer prices, at least not at first. It showed up in asset prices, in wealth gaps, in market concentration, in financial dependence. This is the quantitative easing machine. It stabilizes crises. It protects core institutions. It inflates financial assets. It encourages leverage. It conditions markets to expect rescue. But every machine has side effects. Quantitative easing was introduced as an emergency tool. It was not meant to be permanent. It was not meant to become routine. It was not meant to redefine capitalism. Yet that is precisely what happened. After 2008, central bank balance sheets expanded dramatically. After 2020, they exploded. Markets learned a new pattern. When crisis appears, liquidity follows. When liquidity appears, asset prices recover. When asset prices recover, confidence returns. When confidence returns, risk increases. Then the cycle repeats. This creates moral hazard. If investors believe intervention will always come, risk behavior changes. Leverage increases. Speculation intensifies. Valuations detach from fundamentals. Financial markets become dependent on stimulus. The system begins to require constant support. Consider this. When central banks attempt to reduce their balance sheets, markets react violently. Bond yields spike, stocks fall, liquidity tightens, pressure builds, policy reversals often follow. This means exit becomes difficult. The machine cannot easily be turned off. Now examine inequality. Quantitative easing inflates assets. Stocks rise. Real estate rises. Private equity rises. Who owns these assets? Primarily the wealthy. When asset prices surge, wealth concentrates. Those without significant financial holdings do not experience the same gains. Their wages do not triple. Their savings accounts do not double. Their rent increases. Their cost of living increases. This creates visible tension. The financial system appears stable. Yet social stability weakens. Confidence shifts. Political polarization intensifies. Distrust grows. Now consider inflation. For years after 2008, consumer price inflation remained subdued. Many believed central banks could expand without consequence. But after 2020, something changed. Supply chains tightened, fiscal stimulus expanded, demand surged, liquidity was already abundant. Consumer prices rose sharply. Inflation returned to levels not seen in decades. Central banks were forced to raise interest rates aggressively. When rates rise rapidly, debt becomes expensive. Highly leveraged systems feel stress. Housing slows. Corporate refinancing becomes harder. Government interest costs increase. Financial markets adjust. The machine that provided support now creates tightening pressure. And the larger the balance sheet, the more complex the unwind. This raises an uncomfortable question.